When this headline hit yesterday at 3:18, you can imagine any loan officer who had been working with clients recently and perhaps locked their interest rates received a text or a phone call that said, hey, have rates moved lower? Mortgage rates near 3-year lows ahead of the Fed meeting. And while there was truth to the statement, we're going to talk about that in a second, what's important is what's in the rest of the article, which indicates that there's some really kind of wonky bond nerdy stuff involved in there that make this to be a true case, or at least on the headline. Within the news itself is a statement that the opportunity for rates to move lower is its best chance that it's been in quite some time. So let's dig into what this means. If you don't know me, I'm Rich Hayden with Milestone Mortgage Solutions. I'm happy to share this information with you. So if we're going to look back over the course of 3 years, this chart looks over 5 years, right? And if you've never looked at a mortgage-backed securities market chart before, what this does is it tells you just simple visuals. The higher we are on this chart, the lower that interest rates are. Way over here in 2021, if you've been around for a while, you know that was the era of the 2.5%, 2.75% 30-year fixed rate mortgage. And the lower we are on the chart, the higher the interest rates are. So right here, October of 2023, we are touching up toward 8%. So that is a heck of a swing, right? But here's where we are right now, way over here on the right-hand side of the screen. And if you draw a line, you want to go over here 3 years ago, right, would be 2022, September, that big red candlestick right there. We're kind of, we're below that. That's where things are now over here. So let's look at a 1 month chart. So rates have been getting better. Again, the higher we are on the chart, the lower that rates are. The lower we are on the chart, the higher the rates are. So over the past month or so, we've been advising clients that they should lock in their interest rates with the Fed decision coming. And why is that? Well, that information about the Federal Reserve cutting interest rates, and what they're cutting is the Fed funds rate, not mortgage rates. They don't cut mortgage rates. They don't control mortgage rates. But by doing that, the Fed telegraphed out to the markets, hey, we're going to take this action. So that move by the Federal Reserve that occurred 2 hours ago was already baked into interest rates. And so if we drill down on this a little bit deeper, we advise for people to lock, because in the past, when the Fed takes an action and that news is already expected to occur, mortgage interest rates tend to move in the opposite direction for some period of time. And certainly last year we saw it where rates moved higher substantially, 2 full points in rate. So if you go back and you look just at today, right, the Federal Reserve, everything's going along fine. We advise people to lock. If they didn't lock, what they saw was on the news at 1:50 p.m. at 2 o'clock, boom, the news came out as expected, and you get a little bit of a lift. So one would say, oh, rates are going to get better. And then once the notes from the meeting and the information about the meeting were digested by the market, you saw that the market got worse. And in fact, interest rates got worse through the day because the Fed's forecast for the economy is okay. It's not exceptionally strong. They do say that they'll probably cut again in October and in November, but there's no guarantee of that. And if they do, it may not be to the liking of what some people are looking for. So anyway, when you see the news, you finally get around to this and you're like, oh, hey, rates are lower. They're probably not, because the reality is the news on the ground hit and then rates got worse, which is what we were projecting, because that's how it goes sometimes when you really dig into what's out there. So lean on me if you need me. I'm at 703-957-0790. Rich Hayden. Bye-bye.